So welcome for today's class. That's AFM class. So for today, we also still be continuing with what we started last week. Last week, we are doing on financing decision. So still today, we'll also be doing financing decision. And today, I want us to cover the theories in the capital structure. So in the theories of capital structure, we'll be looking at what are the factors to consider when making the capital structure decision. So for example, last time we showed how to get the proportion of the debt, proportion of the equity, proportion of the preference share. So what determines that the debt should be higher than the equity or the equity should be higher than the debt? So those are the factors to consider when making the financing decision. So one of the factors we need to consider when making the financing decision is the capital structure, or is what we call the financing risk or the financial risk. Also, we need to look at the industrial norm. What are the other companies in the same industry doing? Also, we can look at the ownership, the members. Are they controlling through the issue of shares, or they prefer using of the debt? That's the ownership and the management, etc. So let's go to the whiteboard so we discuss more. So you're looking at the capital structure theories and the capital structure of the company. And the capital structure of the company, this refers to, this refers to the long-term sources of finance. So when we talk about the capital structure, we are looking at the long-term sources of finance in the company, such as, now for the long-term sources of finance in the company, we have the equity. Also, we have the debt or the debentures. Also, we have the preference shares. Yeah, that's what forms the capital structure of the company. Then we have what we call the financial structure. Financial structure. The difference between the capital structure and the financial structure is that the financial structure considers both long-term and short-term sources of finance. Short-term sources of finance. But for the capital structure, only will consider the long-term sources of finance. Then let's look at what are the factors to consider. What are the factors do we consider when making capital structure decision? When making capital structure decision. And when making the capital structure decision, we have some factor we need to determine. One being the business or the total risk. Business or the total risk, this is one of the factor. Then we also need to look at the corporate tax rate. So this means that now for the corporate tax rate, if the tax rate are higher, the company is recommended to use more debt. Because when you use the debt, we have what we call the interest tax shield benefits. But if the tax rate are lower, so in that case, you can issue more equity or more shares. Then we also have the management and the ownership. Management and the ownership. Now, when the company owners, they want to maintain or they don't want to dilute the ownership, what they usually do, they prefer to use the debt instead of issuing more shares. So this is what it means. Assuming the company has 300 or 3 million ordinary share, and they need to raise more capital. So in this case, let's assume they want to raise a capital worth 6 million. Now they have the option of either the debt or the equity. So in this case, if the management fears what we call dilution, they don't want other shareholders. So in this case, they prefer to raise the capital through the issue of the debt. But if they don't fear the dilution of the ownership, they can issue more share to invite more shareholders or more share owners. So that's the management and the ownership. Another factor we need to consider is the industrial norms. Industrial norms means that what are the other companies in the same industry doing? And then, lastly but not the least, we have the component cost of each source of capital. Each source of capital. When we talk about the component cost of each source of capital, for example, we say that we have the cost of equity, cost of preference share, and the cost of the debt. So we need to consider the cost of the equity, the cost of preference share, and the cost of the debt. And from there, now you get the average. That's the WACC. So this is another key factor which you need to consider when you are making the capital structure decision. Good. So now let me go to another part. I want us now to look at the capital structure theories. Now, for the capital structure theory, there are three types of capital structure theories. Type of theories in the capital structure. One is the net income theory. Then we also have the net operating income theory. Also, we have the traditional theory. Yeah, those are the capital structure theories. And when we talk about the capital structure, we need to look at what we call also, when do we determine, when do we say that we have an optimal capital structure? Optimal capital structure. We usually say that we have an optimal capital structure if the value of the company is at maximum and the WACC is minimum. So this is where the value of the company is maximum, and the WACC is minimum. Yeah, that's when we say that our capital structure is optimal. When the value of the company will be maximum and the W, or the cost of capital, is minimum. How do we get the value of the company? The value of the company. To determine the value of the company, you just need to take the value of equity plus the value of the debt. Yeah, it's the value of the equity, then you add the value of the debt. That's how you get the value of the company. And then we also usually say that if the company is all equity financed, when the company is all equity financed, that means they have no debt in their capital structure. This company is said to be ungeared or unlevered company. Yeah, when the company has no any debt, or the company is all equity financed, we say that that company is ungeared or it's unlevered. Then when the company capital structure, comprise both equity and the debt, that company is said to be geared, or that company is said to be levered. So if you say that the company is levered or is geared, that means they have the debt in their capital structure. But when we say that they are unlevered or ungeared, that means they have no debt in their capital structure. Good. So let's go look at something else. And then when we're looking at the capital structure, theories, one of the major assumptions is that it assumes only debt and equity exist. So when we be looking at those capital structure theories, we'll not be considering the preference share. We'll only be considering the debt and the equity. So in this case, we'll not be considering the preference share. So that's one of the assumptions that we are saying that, that the capital structure is made up of two components. That's the equity and the debt. Good. Now, then we can see that. Remember, in our previous class, we say that the financial risk, or we can say that the leverage, we have said that levered and unlevered. So when you talk about leverage, what does leverage mean? Now, leverage is the use of the debt. So this refers to the use of the debt, in the capital structure. And you know very well, if you use the debt in the capital structure, that debt increases what we call the financial risk. So debt increases financial risk. And then we say that, how do we measure financial risk? Financial risk is measured using the beta factor. That financial risk is measured using beta factor. Now, in case of the capital structure theory, how do we get the beta factor? So first of all, let's look at the beta factor of ungeared firm. The beta factor of the ungeared firm is given by taking the beta factor of the levered firm, you divide by 1 plus debt over equity, 1 minus tax. That's how you get the beta of ungeared firm. The beta of the levered, you divide by 1 plus the debt over equity, 1 minus tax. Then, if you want to get the beta of levered firm, you just make this the subject. So that means you multiply by both sides by this denominator. So that means to get the beta of the levered firm, you take the beta of ungeared firm, then you multiply by 1 plus debt over equity, 1 minus T, where T is the tax rate. So that's how you can get the beta of the both ungeared and the beta of the geared firm. So now let's try an illustration. We want to do an illustration. June 2011, question 2A. June 2011, question 2A. Yeah, hoping we are there. We are told that Kitunda Limited has an estimated cost of the debt and equity for various financing gearing levels as follows. So we have the proportion of the debt. So that's the weight of the debt, capital. Then we have the required rate of returns for both debt and equity. Now, this required rate of return is the same as the cost of the debt and the cost of equity. Required, the optimal capital structure. So how do we get the optimal capital structure? If I take you back, so we are doing June 2011, question 2A. The question, they want the optimal capital structure. We have said that the optimal capital structure is where the value of the company is maximum and WACC is minimum. Now, based on the information given, in this case, we're only given the proportion or the weight and the required rate of return for both debt and equity. So based on that information given there, Yeah, based on that information given. So you can either get the value of the company or you get the WACC. But based on the information given here, so it can only help us to get the WACC, but not the value of the company. So and how do we get the WACC? We said WACC is the weight of equity, cost of equity, plus weight of the debt, cost of the debt, 1 minus T. So in this case, we don't consider the cost of preference share. Why? We have said that when dealing with the capital structure theories, one of the assumptions is that the capital structure is made up of two components. That's the debt and the equity. So no preference shares. So you have the proportion of the debt. Now this is the weight of the debt. For example, the first one, the weight of the debt is 0.9. That means the weight of the equity will be 0.1. The second one, it's 0.8. That's the proportion of the debt. That means the proportion of the equity will be 0.2. And then you have the required rate of return. In this question, you are not given the tax rate. When not given the tax rate, ignore that. But if you are given the tax rate, you have to factor in the tax aspect. So what means is this? So the first one, the weight of equity tumeona ni 0.1 because the weight of the debt was 0.9. So the other one was 0.8, kwa hivyo itakuwa 0.2, 0.3, 0.4, 0.5, 0.6, 0.7, 0.8, 0.9, and 1. Those are the weight of the equity. Then you multiply by the cost of equity. Now, for the cost of equity, we are given there the required rate of return. For the equity, you multiply by this required rate of equity. We have 37, 36, mpaka chini. So we have 37, 36, 35.5, 29.1, 25.2, 20.4, 15.6, 13.5, 13.1, and 13. Then you add weight of the debt. Now, you're already given here the weight of the debt. Yeah, those are the proportion of the debt capital. We have 0.9, 0.8, 0.7, mpaka chini. So the weight of the debt, we have 0.9, 0.8, 0.7, 0.6, 0.5, 0.4, 0.3, 0.2, 0.1, and we had 0. Then you multiply by the cost of the debt. Now for the cost of the debt, already given there. Yeah, here we have the required rate of return for the debt. But in this case, you're not given the tax rate, so you ignore the tax. So the cost of the debt, the first one was 9.4, 8.2, 7.4, 6.9, that one was dash. Now you can get the WACC. So we have said that in this case, since we are not given the tax rate, you ignore this aspect. That means there is no that interest tax shield benefits. So this one will get 12.16%, 13.76%, 15.8. Good. So now let's answer our question. What is the optimal capital structure? So you come to the WACC, you select the WACC, which is minimum. Now ukiangalia hapa, the minimum WACC we have here is 12.02. So that means the optimal capital structure is where, number one, equity it's 0.8 or 80%, and the debt is 0.2 or 20%. And we are through with that question. Good. Hoping we are okay up to that. That's all of that question. So now let's look at, we have said that we have three theories of capital structure. I want to start with the first one. The first theory is the net income theory. That will be my first theory. So for the net income theory, according to this theory, the fundamental assumption is that the financial risk does not affect the individual cost of capital. That's the major assumption of the net income theory. That the financial risk is that the financial risk does not affect the individual cost of capital. That is, the leverage does not affect the cost of the debt and the cost of equity. Also, it argues that the cost of the capital or the cost of the debt, that the cost of the debt will be always or will always be lower than the cost of equity. Yeah, and that's the fact that always the cost of the debt is always lower than the cost of equity. For example, if you get the cost of equity is 13%, you'll get that the cost of the debt will be lower than 13. For example, let's assume 10%. Why is the case? This is because, you see, for the cost of the debt, or the debt has what we call the interest tax shield benefit. That means the debt is allowable for tax, but equity is not allowable for tax. That's why the cost of the debt will always be lower than the cost of the equity. Another thing why the cost of the debt is always lower is because, you see, the debt holder, such as the debenture holder, they have what we call assured returns. They have assured returns as compared to the ordinary shareholder. So those are the two reasons why the cost of the debt will always be lower than the cost of equity. Then, under this theory, how do we determine the value of the company? So the value of the firm is determined as follows. Is determined as follows. So this is how we get the value of equity of geared firm. We start with the value of equity of ungeared firm. We have said that ungeared firm is a firm with no debt in its capital structure. So, and this one you get the EBIT, 1 minus the tax, you divide by the cost of equity of ungeared firm. And then, how do we get the value of equity of geared firm? Now, geared firm is a company with debt in its capital structure. So you take the EBIT. Since we have the debt in this case, first of all, you have to pay the interest on that debt, and then you tax it. Then you divide by the cost of equity of the levered firm. KEU, this is the cost of equity of ungeared firm, and this is the cost of equity of geared or levered firm. So you need those formula to be at your fingertips. And then you need to note that, let me write you an NB. Now, the value of the equity of the geared firm, the one you get here. You see here at the denominator, we have the cost of equity of ungeared firm. The cost of equity of ungeared firm will be equal to WACC of the ungeared firm. Let me repeat again, that the cost of equity of ungeared firm will be equal to the WACC of the geared firm. Good. So with that, now we can try one illustration. Let's do this question. Yeah, June 2008, question 2A. We are given that the following extract of the balance sheet of Mapato Limited shows the capital structure of the company as at that 1st December 2007. So we have the ordinary share capital, we have the reserves, shareholders' equity, long-term liability, we have 14% debenture stock, par value, it's 500. Then we have the capital employed. The management of the company considers the above capital structure to be optimal. Additional information. So, number one, before even we proceed, is our capital structure, is our company geared or ungeared? So you need to answer that. Is the company geared or ungeared, based on the information given here? Yeah, our company is geared because we have the ordinary share capital and still we have the debt of 14% debenture stock at par value of 500. Additional information. The company's earning before interest and tax average to 75 million per annum, and these earnings are expected to be maintained in the foreseeable future. The ordinary share are currently trading at 400 per share. The market price of the debenture is 525 per debenture, and the corporate tax rate is 30%. Required. Using the net income approach incorporating taxes, calculate the company's, number one, is the cost of equity. Number two, after tax cost of the debt, market weighted, market value weighted. And lastly, number three, the market weighted average cost of capital. That's the WACC. So tuanze na ya kwanza, the cost of equity. So number one, they want the cost of equity. We have said that under this method, number one, our company is geared. How do we get the value of levered, the value of equity of levered firm? Tumesema the value of equity of levered firm, you'll be taking EBIT, then you pay the interest, 1 minus the tax, over cost of equity of levered firm. This is the cost of equity of levered firm. Now, in this case, they want the cost of equity. This is what they want. So we need to make this the subject. How do we make the, that one the subject? So that means cost of equity of levered firm will be Here it a change. You just multiply both sides by KEL, and then you divide by the value by the value. So you'll get EBIT minus the interest, 1 minus T, you divide by the value of equity of the delivered farm. This is the value of equity of the delivered farm. So in that case, we are given note number 1, the EBIT we are given was 75. We minus the interest. How do we get the interest? This is how we get the interest. You see here we have 14% debenture stock of 118,500. So you just take 14% of 118.5. Because you see, like in this case, our EBIT we are given in million. So you make your figures in million. The 75 was in million. So to get the interest, you just take 14% of 118.5. 118.5. So, and that one will get 16.59 million. So it's EBIT, which is 75, minus your interest, which is 16.59, 1 minus tax. We are given that the tax rate is 30%. So if the tax rate is 30%, that means 1 minus 0.3 will be 0.7. Then you divide by the value of equity of delivered farm. Let's get the value of equity of delivered farm. Value of equity. Now, how do you get the value of the equity? Now, the value of the equity, you use the market weighted. This is what I mean. For the ordinary share capital, we have 62.5 million, of which the par value was 125. So what you do, you take 62.5, you divide by 125 to get the number of ordinary shares. After you get the number of ordinary shares, then you multiply by the current market value. So let's go to note number 2. The ordinary share are currently trading at 400 per share. So the value of the equity, it's 62.5. You divide by the par value, which is 125, to get the number of ordinary share, and then you multiply by the market value, which is, we are told that the ordinary share are trading at 400. And you get the value of the equity currently is 200 million. So we go back to our formula here. The value of equity of delivered farm is 200 million. And by that, you'll get 20.4%. That is the cost of equity. Number 2 of the question, they wanted the after-tax cost of the debt. After-tax cost of the debt. In our previous class, I showed you how to get the cost of the debt. And we say that we have redeemable and irredeemable. Now, in this our case, our debenture is irredeemable, since we are not given the maturity period. In case of irredeemable, we say that the cost of the debt is equals to interest plus the value of the debt, 1 minus tax. That's how you get that. So how do we get the interest? Now, when we're getting the cost of an individual or a cost of the debt, tulisema you take the rate, you multiply by the par value. So you'll take 14% of the debenture and the par value is 500. The one we had done, it was 14% of 118.5. That's the total interest for the year. But the interest per one share, you just take 14% of the par value, which is 500. Then you divide by the value of the debenture. Let's go to note number 3. Number 3, we are told that the market price of the debenture is 525. As simple as that. So the interest, you'll take 14% of the par value, and the par value is 500. You get the interest. You divide by the value of the debenture, and we are told that debenture are currently trading at 525, 1 minus T. Our tax rate is 30%. 1 minus T will be 0.7. Then you multiply by 100%, and you'll get 9.3. Good. And then rastri number 3, they wanted WACC. How do we get the WACC? WACC is the weight of equity, cost of equity, weight of the debt, cost of the debt, 1 minus the tax. We already have the cost of equity, ndio hii tulipata hapa, which is 20.4%. Also, you have the cost of the debt, net of tax, ndio hii 9.3. So what we need now is just the weights. And how do we get the weights? When I was giving you as class the difference between WACC and WMCC, we see that for WMCC, we use the target of the optimal capital structure to get the weights. But for WACC, we use the market rate or the market averages. So that means, how do we get for the equity? And how do we get for the debt? Tushaona equity ni rahisi sana. Eh? For the equity, it was 62.5. You divide by the par value, which was 125, and then you multiply by the market price per 1 share, tulikuwa tumepewa, which was 400, na tumepata ni 200. I want us to do the same for the debentures. Now for the debentures, we have 14% debenture, the par value is 500. So you'll take 118.5, you divide by the par value, which is 500, to get the number of debentures. After you get the number of debenture, then you multiply by the value of 1 debenture as per the current price. Note number 3. The market price of the debenture is 525 per debenture. So we have seen that the debt is 118.5. You divide by the par value, it's 500, but they are currently trading at 525. And you'll get 124. Then you add the total, eh? So it's 324. So now, can we get the weights? The weights is very easy. For example, this one, you take 200, you divide by 324 to get the proportion. You get approximately 0.62. 124 divided by 324, you will get 0.38. So now we can get our WACC. So we had the formula here. It's weight of equity. Now the weight of equity tumepewa equity hapa, which is 0.62 times the cost of equity. And we have the cost of equity of the rivered farm, which was 20.4%. You add weight of the debt, and we have gotten the weight of the debt, it's 0.38. You multiply by the cost of the debt net of tax. And we have the cost of the debt here, net of tax, tumepata ni 9.3%. So what you get, 16.18%. So now this will be the cost of the capital. This is the cost of capital, or the WACC. Can screenshot that. So let's try another question. June 2009, question 3B. June 2009, question 3B. So you're doing question 3B. So the management of Shujaa Limited is excited that the government has reduced the tax, the corporate tax rate from 33% to 30%. This tax cut is expected to increase the net present value of operating cash flows from the company by 15 million. So that's the incremental EBIT. The current capital structure of the company is as follows. So you have the ordinary share capital, 5 at par value, retained earnings, share premium. Then we have the shareholders' equity, 10% debentures. The par value is 100. The company shares are currently selling at 32x dividend. That means exclusive of dividend. And the debenture are selling at 135 cum interest. Cum interest, that means it's inclusive of interest. So to get the value of the debenture, you have to reduce or you have to deduct the interest. So nataka turudi hapo tena. The company share are currently selling at that 2x dividend. So that one is okay, it's exclusive of dividend. And the debenture are selling at 135 cum interest. So to get the value of the debenture, you take 135 to interest. How do we get the interest? Tuangalie hapa. It's 10% debenture and par value is 100. So it's 10% times 100, which is 10. So that's the interest. So you'll take 135 minus the debenture interest, which is 10. Then number 2, the equity beta is 1.2, the market return is 13%, and the debt capital is risk-free. Now, based on that information, hiyo ni portfolio theory, na tulisema under that, you can get the cost of equity by using what we call the security market triangle equation. Assume that the cost of the debt and the market price of the debenture will not change as a result of the tax cut. Required. Determine Shujaa Limited weighted average cost of capital before the tax cut. That's the WACC. Then number 2, determine the expected market price per share, that's MPS of Shujaa, after the tax reduction. You get your 12 marks. So tumeona the value of the debt, tulikuwa tumeambiwa it's 135, but was come dividend, come interest. So we tukatoa interest. Na interest tumesema it's 10% and the debenture per value was 100. So it's 135 minus 10, so it's 125. Then number 1, they want the WACC. So how do we get the WACC? It's weight of equity, cost of equity, plus weight of the debt, cost of the debt, 1 minus the tax. Tulisema hapo, I don't consider the preference, even we don't have the preference shares. So tuanzane na weights. Let's get the weights. Weight of equity, weight of the debt. So for the equity, and then we get for the debt. So for equity, utakuja hapa. Ordinary share capital, it's 30 and the par value is 5. So it'll take 30 divided by 5 to get the number of ordinary shares. Then you multiply by, tukuja hapa, the company shares are currently selling at that 2. Then you multiply by that 2. To get the cost of the debt, ukuja kwa debenture. It's 40, you divide by the par value, which is 100, to get the number of debentures. And then you multiply by the value of the debenture, exclusive of interest. So for the equity, tumeona it's 30, you divide by 5 to get the number of ordinary share, then you multiply by the market price, which is that 2x dividend, and you get 192. For the debt, it was 40 million, par value was 100 to get the number of debentures, then you multiply by 125. This we have gotten here the value of the debenture, 125, and you'll get 50. So if you add the two, you'll get the total is 242. So to get the proportion of the weight, you take 192 divided by 242. That one you get 0.79. 50 divided by 242, you get 0.21. We already have the weights. Now let's get the cost of equity and the cost of the debt. So to get the cost of equity of Rivered Farm, when we're doing the topic of portfolio theory and CAPM, tulisema if you use the security market line, risk-free plus expected return of the market minus risk-free, you multiply by the beta factor. What you get as the return of the security is the same as cost of equity. That's what I said. Eh? So let's use that formula to get the cost of equity. So we're told that the equity beta is 1.2 and the market return is 13%. Debt capital is risk-free. Kwa hivyo risk-free rate utakuja hapa kwa debenture, which is the debt. Eh? The 10% is our risk-free rate. So it will be, the risk-free rate is 10% plus, we are given the return on the market. Expected return on the market we are given was 13, minus risk-free rate, which is 10. You multiply by the beta factor, and the beta factor we are given as 1.2. And you have 13.6% as the cost of equity of Rivered Farm. So you already have the cost of equity. Now what you don't have is the cost of the debt. How do we get the cost of the debt? This is an irredeemable debenture because you are not given the maturity period. So to get the cost of the debt, you take the interest, you divide by the value of the debt, 1 minus tax. Kwa hivyo itakuwa, the interest is just, ni tulikuwa tumepata hapa, 10% of the par value, which is 10. So it's 10% of 100. Divide by the value of the debenture, ndio hii tumeona hapa. The debenture are currently trading at 125 exclusive of interest. So it's 125 times 1 minus T. 1 minus T. Our T, before the tax cut, the tax rate was 33%. That's what we are given. So itakuwa, you multiply by 0.33, like that. Utapata that one will be 5.36%. Now, before the tax cut, the tax rate was 33%. And they want the WACC before the tax cut. So to get the WACC, you take weight of the equity, and the weight of equity you're given is 0.79. You multiply by the cost of equity. We have the cost of equity here, which is 13.6, plus the weight of the debt, and here we have the weight of the debt. The weight of the debt is 0.21 times the cost of the debt. And the cost of the debt here is 5.36. Usitoe hii tax, because when you are getting the cost of the debt here, it's already exclusive of the tax. So like that. And this one you get 18.87%. As easy as that. So now let's look at the part 2 of the question. Now, part 2, you are told that determine the expected market price per share of JAR Limited after the tax cut. So they want the market price per share. So the question here is the MPS. How do we get the market price per share? So to get the market price per share, you just take the value of the equity, you divide by the share. And how do we get the value of the equity? So value of equity of Rivered Farm, tulisema you take EBIT minus the interest, 1 minus T, then you divide by cost of equity of Rivered Farm. And you are given the EBIT. How much was the EBIT? Now for the EBIT, Hapo ulikuwa umeambiwa this tax cut is expected to increase the net present value of operating cash flow, operating near EBIT, of the company by 15 million. So we have that. Then we minus the interest. This is how we get the interest. So the interest, you take 10% of 40 million to get the total interest for the period. So EBIT, it will be 15 minus interest. Tumesema interest in 10% of 40, of which you will get 4 million. 1 minus T. Tumeambiwa we are getting MPS after the tax cut. So it's 1 minus 0.3. After the tax cut, tax is to 30%. Divide by cost of equity of the Rivered Farm. We already have it. Cost of equity of Rivered Farm was 13.6. So it's 0.136. You get the value of the equity. In that case, you have 56.6 million. Now, that's not the market price per share. This is the value of the equity of Rivered Farm. To get the market price per share, you just take the value of the equity, ikiwa total, you just divide by the number of ordinary shares. And the value of the equity, we have it's 56.6. You divide by the number of shares. So can we get the number of shares? Yes, tuangalie hapa. When you're getting the weight of equity, it's 30 divided by 5. Ndio tupate the number of ordinary share. You see, the total value was 30 and the par value was 5. So it's 30 divided by 5 and you'll get 6. Yeah, to get the number of shares. You just take 30 divided by 5, you get 6. To get the market price per share will be 9.4. Good. Are we okay up to that point? So that's the first theory of the net operating. Sorry, not operating, for the net income theory. That was the net income theory. So now we can go to the second theory. The net operating theory, or what we call Modigliani and Miller theory. So you're going to the second theory, the net operating income theory, or it's also known as M&M, or Modigliani and Miller proposition theory. Yeah, those are the gurus. So now, under net operating income theory, or according to Modigliani and Miller, is that the capital structure is irrelevant. Even if walisema, both Modigliani and Miller walisema that the capital structure of the company, the capital structure of the firm is irrelevant. Why? Since it does not affect the value of the company and WACC. So the capital structure of the firm is irrelevant since it does not affect the value of the company and the WACC. And then it was founded under the following assumptions. What are the major assumptions of this theory? Is that there is perfect and efficient capital market, efficient and perfect capital market, then all the firms are the same. Yeah, all the firms in the same industry, they are all equal. That's what he assumed. Yeah. Now, according to this guy, how do we get the value of the company? So according to Modigliani and Miller, how do we get the value of the Rivered Farm, and how do we get the cost of equity of the Rivered Farm? You need to get the two formula. According to him, The value of the levered farm is the value of ungeared plus present value interest tax shield. And how do we get the cost of equity of levered farm? Is equals to cost of equity of ungeared plus, you open the bracket, cost of equity of ungeared minus the cost of the debt over equity, 1 minus T, where PVITS, this is what we call the present value interest tax shield, is equivalent to tax rate, you multiply by the debt. Yeah, that's how you get the present value interest tax shield. By taking just the tax rate, you multiply by the debt. Good. And then kuna kitu ingine tumesema, it was an NB, that the cost of equity of ungeared farm is the same as WACC of ungeared farm. Then, tumesema value of levered is value of ungeared plus present value interest tax shield. Tulisema, how do we get the value of ungeared? Now, the value of ungeared, it can either the value of the equity of levered farm or the value of equity of unlevered farm. Kwa tumepeana that formula. So we can try a question on that. But the most important thing is to note the two formulas there. Yeah. So let's start with this question. December 2005, question 1A. All those without that, but they have the handout. For those with the handout, they can go to handout page 7. Yeah, we are doing question 1A, December 2005, question 1A. So we are told that two firms, A and B, operate in the same industry. The two firms are similar in all aspects, except for their capital structure. The following additional information is available. Number 1, A Limited is financed using 100 million worth of ordinary shares. Kumaanisha A is ungeared firm. You see, they have no debt. Then number 2, B is financed using 50 million of ordinary shares and 50 million in 7% debentures. So company B has both equity and the debt. So that make it a geared or a levered firm. Number 3, the annual earning before interest and tax are 10 million for both firms. That's EBIT. And these earnings are expected to remain constant indefinitely. Cost of equity of A Limited is 10%. That's the cost of equity of A. That's what we call cost of equity of ungeared firm, since A was ungeared. Then the corporate tax rate is 30%. Required. Using Modigliani and Miller model, determine the following. Number 1, the market value of A and B Limited. Number B, the weighted average cost of capital for A and B Limited. So to answer part A, now part 1 of the question, They're asking about the market value for A and B. Tuanze na A. Now we have two companies. We have A and we have B. The difference between the two is only one, their capital structure. Tumeona A is financed with all equity finance. Kumaanisha E ni ungeared or levered, but B is geared. So tuanze na kutafuta value of A. How do we get the value of equity of ungeared firm? Tulisema the value of equity of ungeared firm, you take EBIT 1 minus the tax over cost of equity of ungeared firm. EBIT we are given there. Tumepewa EBIT ya 10. The tax rate was 30%. So that one will be 0.7 divided by cost of equity of ungeared firm. That was courtesy of note number 4. Yeah, number 4 umeambiwa. The cost of equity of A Limited is 10%. Yeah, so the cost of equity of ungeared was 10%, so it's 0.1. So that's 7 divided by 0.1, you get 70 million. That's how you get value of A Limited. Twende kwa B Limited. Now, B Limited is geared. Now, according to Morgan and Mira, to get the value of the levered firm, tumesema ni value of ungeared plus present value interest tax shield. The value of ungeared ni tumepata hapa. The value of ungeared firm was 70 million plus present value interest tax shield. Tumesema unachukua 30% of the debt. Let's go to number 2. Additional information number 2. Number 2 tumeambiwa B Limited is financed using 50 million ordinary share and 50 million in 7% debenture. So you have a debenture worth 50 million. So you multiply by 50. Yeah, like that. So now utapata 85 million to get your 6 marks. Number 2. Number 2 of the question they were asking about the weighted average cost of capital of A and B. They want the WACC, weighted average cost of capital. So ya A ni ngapi? Tumesema the cost of equity of ungeared firm, remember A was ungeared firm, is equal to WACC of ungeared firm. That means the cost of equity of ungeared firm was 10%. Tuende kwa B. B is geared. And you want the WACC. How do you get the WACC? WACC is equals to weight of equity, cost of equity, weight of the debt, cost of the debt, 1 minus the tax. Tuanze kutafuta weights. Or, tulisema, how do we get the value of the firm? Tuanzie hapo. Tulisema, value of the firm is equals to value of equity plus the value of the debt. That's what we said. Na company B tushapata value yake. Here was the value of B Limited, which was 85 million. Is equals to value of the equity. Hatujui equity ni ngapi, but we know the value of the debt. You see here we are given the debt. They had 50 million worth of debenture. So debenture ni 50. So now, can we get the market value or the current market value of equity? You just make it the subject. You upeleke the other side. So itakuwa 85 minus 50 and you get 35. This is what I mean. If the value of company B is 85 million, of which of this 85 million, remember the debenture does not change. The debenture tulikuwa tumeambiwa it was 50 million. Kumaanisha equity ni ngapi? Remember equity keeps on changing because of the changes in the market value. So ndio tunaweka our value of the equity as X and our X you get as 35. After we get that, so now we have the weight of equity and we have the weight of the debt. Also you have the cost of the debt. Remember ni 7% of debenture. Then can we get the KE? That's the cost of equity. According to Morgan and Mira, how do we get the cost of equity of levered firm? The cost of equity of ungeared plus cost of equity of ungeared firm minus the cost of the debt debt over equity 1 minus T. That's according to Morgan and Miller. That's how we get the cost of equity. Cost of equity of ungeared, DOE. The cost of equity of ungeared was 10% plus cost of equity of ungeared, which is 10, minus cost of the debt. Turudi kwa swali. Now, kwa swali number 2. B Limited is financed using 50 million in ordinary share and 50 million in 7% debenture. We already given the cost of the debt. But sometime, to assume hivi, if you are given 50 million of 7% debenture and then umepewa the par value of each debenture, ungetumia ile formula nilikuonyesha. So in this case, you are not given the par value of each debenture. So that means the cost, you'll just use 7%. If you are not given, or if you are given, when you are given the par value, you ungetumia hii formula. Cost of the debt is equals to interest over the value of the D, 1 minus tax to get the cost of the debt. But in this case, we are not given the par value. We are given the entire value of the debenture. Kwa hivyo, the cost of the debt itakuwa that 7%. Then debt over equity. Tumeona the value of the debt ni 50. Na debt of equity ni X, tumeona ni 35. Then you multiply by 1 minus T. The tax rate was 30%, kwa hivyo itakuwa 0.7. So and by that you get 13%. So tumalizie kutafuta WACC. WACC tumesema ni weight of equity. Tuangalie the weight of equity. This how we get the weight of equity. Tumeona equity ni 35. So itakuwa 35 divided by 85 times the cost of equity. Na tumepata the cost of equity is 13%. Plus weight of the debt. This how we get the weight of the debt. Tumeona debt ni 50, kwa hivyo itakuwa 50 over the total, which is 85 times the cost of the debt. Na tulikuwa tumepewa hapa the cost of the debt was 7%, lakini hatukuwa tumetoa tax 1 minus 0.3. So in this case the 7% tulichukua the way it was given. Here the 7% the way it was given. So hatukuwa tumeless tax, so in that case utoe that tax 1 minus T. You'll get 8.24%. So let's try another illustration now. So let's now look at something else. Still under that, Modgren and Miller incorporating personal taxes. Incorporating personal taxes. The one we have done, we have only been incorporating the corporate tax. Now, when M&M incorporated personal taxes, the value of the firm reduces. When the personal taxes are incorporated, what happens is that the value of the firm reduces. Yeah, that's what happened. And how do we get that? So according to Modgren and Miller, if you incorporate the personal taxes, the value of ungeared, how do we get the value of ungeared? The value of ungeared, ilikuwa EBIT, like that. Then tulikuwa tunatoa 1 minus tax. This was the corporate tax. If you incorporate the personal taxes, it's 1 minus the personal tax for the equity. Then you divide by cost of equity of ungeared firm. That's the value of equity of unlevered firm if you incorporate the personal taxes. How do we get the value of levered when incorporating personal taxes? So kumbuka hii tulikuwa tumesema the value of the levered according to Morgan Miller is the value of ungeared plus present value interest tax shield. But when you incorporate the personal taxes, now this will get the value of the levered firm. It will be the value of ungeared, hii sasa. Then you add, to get this, you'll take the debt, 1 minus the corporate tax rate, 1 minus the personal tax for the equity, you divide by 1 minus the personal tax for the debt. Yeah, that's how you get that. The value of ungeared, what you get here, you plus the debt, to get the tax shield, you take 1 minus the corporate tax rate, 1 minus the personal tax for the equity, divided by 1 minus the tax rate for the debt. Tumesema TP and TD. This is the tax rate for the equity, and this one is the tax rate for the debt. So we can try an illustration now. December 2010, question 5B. So we are doing part B of the question. I told that MM Limited has earning before interest and tax of 3 million and 40% tax rate. Its required rate of return on equity in the absence of borrowing is 18%. Now, in absence of borrowing, inamaanisha it's when it's ungeared, wakati hawaja borrow. So in the absence of personal taxes, required, in the absence of personal taxes, determine the value of the company in Morgan and Miller world. Number 1, with no leverage. Number 2, with 4 million in the debt. Then number 3, with 7 million debt. So tuanze na hiyo number 1. So tumepewa hapo, we are given there, the EBIT was 3 million. Then tumepewa the tax rate, tumeambiwa ni 40%. And then the cost of equity in absence of borrowing, that's the cost of equity of ungeared, was 18%. Then the question is, in absence of personal taxes, you determine the value of the company, number 1, assuming there is no leverage. So to assume with no leverage, how do we get the value? It will assume assuming there is no personal taxes. Tumesema the value of ungeared, it's EBIT 1 minus T over cost of equity of ungeared firm. EBIT we have here, it's 3. 1 minus the tax rate. The tax rate is 40%. So 1 minus 40%, you'll get 0.6. Divide the cost of equity of ungeared, which is 18%, 0.18. And you'll get 10 million. Then part 2 of the question, you get the value now with 4 million in debt. With 4 million debt. Now with 4 million debt, now it changes from ungeared to geared. And how do we get the value of levered farm? Is the value of unlevered plus present value interest tax shield. Kwa hivyo itakuwa the value of ungeared is what you have gotten in step number 1, which is 10, plus present value interest tax shield. Tulisema you take the tax rate, which is 40% times the debt, and the debt hapa tumeambiwa 4 million. So that's 1.6 plus that, so we get 11.6 million. And number 3 of the question, with 7 million in debt. Now with 7 million in debt, the formula does not change, it's the same. The value of ungeared, which we had the value of ungeared, which was 10, plus present value interest tax shield. In this case, you take the tax rate, which is 40%, you multiply by the debt, and our debt here is 7. So that's 2.8, so it will be 12.8 million. You get your 9 marks. Yeah, that was number 1, with no leverage, with 4 million in the debt, and with 7 million debt. They had 3. Let's go to part C of the question. Part C. With reference to B above, assume that personal as well as corporate tax now exist. So now part C now will incorporate the personal taxes. The marginal personal tax rate on common stock income. Now, common stock ni ordinary share or the equity. So the marginal personal tax for the common stock income is 25%, and the marginal personal tax rate on the debt is 30%. So the tax rate for the equity is 25%, and the tax for the debt is 30%. Had already been given the corporate tax was 40%. Determine the value of the company for each of the 3 debt alternative in B1 to 3 above, and you comment on your answer to get an additional 7 marks. So it's hard to go part 2. So in this case, we are incorporating. Remember, we incorporate personal taxes. And based on this question, tumepewa the personal tax for equity, it's 25%, and the tax rate for the debt, we are given at 30%. And the normal corporate tax rate, was 40%. So we need to evaluate each. Tuanze na hii ya kwanza. Tumeambiwa for 1 to 3 above. So hii ya kwanza, it was with no leverage. Now, with no leverage, but in incorporating personal taxes, tulisema this I get the value of ungeared firm, you'll take EBIT 1 minus the corporate tax, 1 minus the personal tax rate for the equity, you divide by the cost of equity of ungeared firm. So the EBIT does not change, was 3 times 1 minus corporate tax rate was 40%. Kwa hivyo itakuwa 1 minus 0.4. So you multiply by 1 minus the personal tax rate for the equity. 1 for the equity was 25%, 0.25. Then you divide the cost of equity of ungeared firm does not change. It was 18%, 0.18. And that one you get 7.5 million. Number 2. Number 2 was with 4 million debt. Now with 4 million debt, so how do we get, when incorporating personal taxes, tumesema the value of the levered firm, you take the value of ungeared plus, now if using, when you're getting for the levered, you take the debt, 1 minus the corporate tax rate, 1 minus the personal tax rate for the equity, divided by 1 minus the personal tax rate for the debt. Kwa hivyo itakuwa the value of ungeared so number one, we already have it. The value of ungeared was 7.5 plus the debt, which we are given here, 4 million debt, 1 minus the corporate tax rate. The corporate tax rate was 40%. Kwa hivyo itakuwa 0.6 times 1 minus the personal tax rate for the equity. The personal tax rate for the equity is 25%. Kwa hivyo 1 minus 25, you get 0.75. You divide by 1 minus the tax rate for the debt. The tax rate for the debt was 30%. So 1 minus 30%, you get 0.7. And with that, you get 8.9 million. Industry number 3, with, you see number 3 was with 7 million debt. Also, this one you do the same. The way you have done this one, the formula does not change. What will change? It's only this, peke yake. So itakuwa 7.5 plus, instead of 4 now, we are using a debt of 7. 1 minus 0.6 times 0.75, 0.7. By that, you'll get 10 million. You are supposed to compute this and then you comment on the result. How do you comment on the result? This is how you comment on the result. The first part, or part B, remember you're not considering the personal taxes. With no personal taxes, tulipata, with no leverage, the value of the company was 10. But if you incorporate the personal taxes, with no leverage, you get 7.5. You see there is a change. So that means if you incorporate the personal taxes, the value of the company declines. Tuangalie hapa, with 4 million, with no personal taxes, we had 11.6 million. But if you incorporate the personal taxes, with the same 4 million, you are getting 8.9. From 11.6 to 8.9. Also the same, with 7 million, you had 12.8, but you incorporate personal taxes with the same 7 million, you are getting 10. From 12.8 to 10. So on your comment, you just comment that when incorporating personal taxes, the value of the company reduces or declines. Good. So I want to give you an assignment. I want you to go and try this question. December 2009, question 3C. December 2009, question 3C. Niandike hapa juu. So now, on that, still under this theory, let's look at the last point, at the last thing there. Now we want to look at Morgan and Mira incorporating financial distress cost. Incorporating financial distress cost. Just hoping we are there. Now, for this financial distress cost, we'll be looking at what we call the bankruptcy cost and the agency cost. And according to MMM, when incorporating bankruptcy and agency cost in the model, they concluded that the value of the delivered firm will start declining beyond the optimal structure. I repeat again, if you incorporate the financial distress cost, those are the bankruptcy costs and agency costs, that the value of the delivered firm will start declining beyond the optimal capital structure. And in that case, how will you get the value of the delivered firm? The value of the delivered, you just take the value of ungeared plus present value interest tax shield, but you minus the present value of financial distress cost. Yeah, that's how you get that. The value of ungeared plus present value interest tax shield minus present value of financial distress cost. Now, for the financial distress cost, I want us to look at that. What are the financial distress costs? When we say the company is facing financial distress. So I don't want to write that. I want us to discuss that. The financial distress. And this is an event that occurs when the company is facing financial problems. That's when you say the company is distressed. They include bankruptcy, where the company is unable to meet its financial obligation. And if I'm going through financial distress, may not necessarily fail, but may survive or ultimate a position to identify the surviving strategies. And what are the forms of financial distress? We have technical insolvency, legal bankruptcy, we have economic failure, business failure, fraud-based insolvency. Fraud-based ni unapata your outflow are more than the inflow you are getting. Yeah? Then unapata business failure, maybe your contract has been terminated. Economic failure, this one the economy is failing, or the cost of covering all the necessary cost is down. The legal bankruptcy, this one the company is declared bankrupt by the law. And then technical insolvency, this is why the company is unable to meet its current financial obligation. Then to the opportunity, we have type of financial distress cost, and they are classified into three. We have direct distress cost, indirect distress cost, and we have the agency cost. Those are the three classifications of financial distress cost. Now, with the direct cost, direct financial distress cost, this cost include when the company sell its asset to improve financial position of the company. Kama mlikuwa na gari tatu in the company, wanauza moja so that waweze kulipa mishahara. Those are what we call direct cost. Good. Also changing the dividend policy. Hiyo ni Kiingereza mtasoma. For indirect cost, the same hata hiyo mtasoma. As well as the agency cost. Then also you look at the indicators of financial distressed company. How can you know that your company is financially distressed? Number one, there is reduction in the dividend per share, closing down of some branches, also retrenchment of staffs wanaanza kufutwa kazi. Instead of making profit, also you are making losses. You have the accumulated losses. Also top management resigning from the company. We have operational inefficiencies. The number of defects has been increasing. Also slow moving item leading to obsolescence, frequent losses, loss of key customer or staff or supplier. Yeah, that's another thing that can make your company to collapse. If you lose the key customer, assuming this customer has been contributing to at least, let's assume, between 40 to 60% of your revenue, or you lose the major staff. And the major staff is not necessarily have to be the top management. Kuna mtu wa technical huko chini, the moment amewacha kazi, the entire company collapses. And also loss of supplier. And also, number 10, we have inability to meet clients' demand. Then what are the options of the time of the financial distress? Hata hiyo ni Kiingereza, hiyo mtasoma. And then the causes of financial distress or the corporate failure. Yeah, so before tukuje kwa prediction of corporate failure. Good. So let's do the last question there. Because next time sitaanzia hapo. Next time I'll be doing on another thing. So let's try this question. December 2007, question 1B. December 2007, question 1B. We start with question 1A. With reference to capital structure, briefly explain the following costs. Number 1 is the financial distress cost. Number 2 is the agency cost. Number 2, or number B, Downox Limited, an unlevered firm, generates an average earning before interest and tax of 20 million per annum. The market value of the company, as of that 1st October 2007, the company financial year end was 120 million. So what is that? The market value of the company as at that 1st October was 120. Now that's what we call, you see, number 1, the firm is unlevered firm. So this 120 is the value of equity. You see, it's the value of equity of ungeared firm. Good. The management of the company are considering the use of the debt finance and provide the following additional information. Number 1, the estimated present value of any future financial distress costing 80 million, already given it at present value. Then number 2, the probability of financial distress would increase with leverage according to the schedule below. Following schedule, we are given the value of the debt. If you use a debt of 25 million, probability of financial distress will be 0. Tukitumia 50, the probability will be that, up to 200 million. Then the corporate tax rate is 30% required. The company cost of equity and weighted average cost of capital as at that 1st October 2007. They want the cost of equity and the WACC. You get 2 marks. Hiyo ni rahisi. Tulisema cost of equity is the same as the cost of equity of ungeared firm will be the same as the cost of equity, or the same as the WACC. So how do we get that? So they want the cost of equity. So I get you back to the formula. Tulikuwa tumesema the value of ungeared firm ilikuwa EBIT 1 minus T over cost of equity of ungeared firm. So in this case, we want this. They want the cost of equity. So how do we get the cost of equity? You make it the subject. It will be EBIT 1 minus T over value of equity of ungeared firm. So the EBIT given there, tuliambiwa ilikuwa 20. The tax rate was 30%. So it will be 0.7. The value of ungeared firm, tulikuwa tumepewa hapo, it was 120 million. If you have the past paper, you can see it. For the first paragraph, tulikuwa tumeambiwa the market value of the company as at that 1st October 2007, the company financial year end was 120 million. Yeah, that was the value of the equity. It was 120. And you get that the cost of equity will be 11.67. Then tukasema cost of equity of ungeared firm will be the same as the worker. So you already have that. Let's go to part 2, part B of the question. Part 2, umeambiwa the company's optimal level of debt finance using Morgan & Miller with tax model excluding financial distress cost. You exclude the cost of financial distress. So number 1, you have to interpret the question. What's the examiner wants? The optimal level of debt. Let me take you back. Tulisema the optimal capital structure is where the value of the company is at maximum and the WACC or WACC is at minimum. Kushike hiyo. Where the value of the company is maximum and the WACC is minimum. Now, based on the information given here, is it easier for you to get, or will it enable you to get the WACC or the value of the company? So based on the information given here, you can only get the value of the firm. So tutafute the value of the firm, and then tuchukue the optimal will be where the value of the company will be maximum. And how do we get the value of levered firm? Now, if we incorporate the debt, because in this case we want to use the debt, If you use the date, the value of ungeared will be, the value of the delivered will be value of ungeared plus present value interest tax shield. And you already have the value of ungeared. It will got member 120. Ndio hii hapa. So it will be like this. For example, the first one. You see, tunaangalia at all levels of the debt. Like the first one, utachukua 120, which is the value of the equity, plus present value interest tax shield. Tulisema to get the present value interest tax shield, you just take the debt, of which we have the first debt is 25, times the tax rate. Note number 3, the corporate tax rate is 30%. Namaanisha hivi. Like the first one, utachukua the value of ungeared, tumepewa ni 120, itakuwa 120 plus present value interest tax shield. You just take 30%. The first one we are taking a debt of 25. Hiyo ingine ya pili itakuwa 120 plus the second one we are taking a debt of 50 million. So it's 30% of 50 million. Blah blah mpaka chini. So wacha nizebe kidogo nimpe hiyo. Ndio hiyo. I have done it there. The value of ungiven zote zilikuwa 120. Then you take the tax rate 30%, you multiply by the respective debt. And then uangalie zote. After you get the value of the delivered firm, tulisema the optimal is where the value is at maximum. So ukiangalia zote, the maximum was 180. So that means the optimal debt, kwa hivyo tutachukua debt ya 200, 200 million. Na hiyo imeisha hivyo. Then part 3 of the question. Part 3 of the question, number 3. The company optimal level of debt using M&M with tax model incorporating financial distress cost. So if we incorporate the financial distress cost, tulisema, how do we get the value of the firm? Ndio hii. The value of the delivered firm, if you incorporate financial distress, you take the value of ungeared plus present value interest tax shield, na hii tumepata hapa, the first, the number 2, and then you raise the present value of financial distress cost. So for example, hii ya kwanza, you see the first one, hii tulikuwa tumepata, the value was 127.5. Hii ya pili, number 2, tulikuwa tunapata 135. So now to do part 3, if you want to use this formula, value of ungeared plus present value interest tax shield, tumepata ni hizi. Ya kwanza ilikuwa 127.5, ingine ilikuwa 135. You minus present value of financial distress cost. Turudi kwa swali hapo juu. Number 1, additional information number 1. The estimated present value of any future financial distress cost is 80 million. Kwa hivyo utachukua 80 million times the first one here 25 million. The probability of that happening, probability of financial distress was 0. The other one was 0.0125. So what I mean here, utachukua in your first one, in your second one. It's 127.5. That was the value here. Then I'm raising the present value of financial distress cost. It's 80 million, but you are given the probability of happening. If you use a debt of 25, probability itakuwa 0. Kwa hivyo itabakia kuwa 127.5. If you use a debt of 50, probability ilikuwa inapanda to 0.0125. Unapata hiyo. That's what I have done here. Yeah, what I gotten here at step number 2, ndio nimeweka tu hapa. Then I have deducted the present value of financial distress. Kila mahali ni 80 times probability of occurrence. Good. And with that, I wish to bring the end of today's class. So now I want to give you like 1 minute. In case you have a question, kindly raise your hand. Usitype hapo. Any question? Good. Naona kama hakuna swali. So next class, God willing, will still be continuing with the same thing. We say that this the one is the widest topic. And then I have a request. So the notes, today we are not sending the notes. We are using the notes we had sent last class. And then another request. For those who are requesting for AFM logging ID, so kindly be requesting the AFM logging ID before 12 ama before 1. Kindly. Si kuitisha wakati class ya SG inaendelea. You see the person responsible to, for sending you the logging ID is also our lecturer for SGE. So kindly be requesting for the logging ID, both for FM and SGE, for those doing SGE, before 1. So it's just a kind request. Good. So have a nice class. Have a nice evening.